Hey traders, welcome back to uGenesys. Today we're diving into the fascinating world of fair value gaps. You might have come across the term fair value gaps, also known as imbalances. In this video, I'll do my best to break down the concept of fair value gaps for you. Then, we'll head over to our chart to explore where to find these gaps and understand their significance. Right here, I've put together a sketch to help illustrate what a fair value gap is before we jump into the chart and spot them in action. Imagine a healthy price action on this side of my drawing, where price is transferring liquidity from one level to another. Consider a scenario with 3 candles labeled 1, 2, and 3. For a price action to be considered healthy, it's essential for the high of the first candle, 1, to connect with the low of the top candle, 3. This alignment of highs and lows characterizes a well-balanced price movement. Likewise, during a downtrend, the low of a candle must correspond with the high of the subsequent one. This alignment indicates a robust price movement. However, when this linkage is missing, as seen between just 2 consecutive candles, a fair value gap can't be identified. It requires a minimum of 3 candles for detection. The existence of this gap often arises due to rapid price shifts where buyers couldn't facilitate selling effectively. This usually occurs when price moves rapidly and there isn't enough liquidity to fill the gap. As a result, price tends to refer back to this unfilled gap as demonstrated in the diagram. Observe the visible gap right here. That's your fair value gap. When we analyze our chart, you'll see how to identify these gaps. This gap acts as a reference point for price movements. This is what we call an institutional reference point, or the institution's footprint. When price revisits this gap, we anticipate specific actions to occur around that level. In the following segments, I'll demonstrate how these concepts play out practically on a live chart. Keep in mind that understanding the concept of a fair value gap is crucial. Notice another fair value gap amidst the downward candles here. Notably, one is a solid price action, while the other reflects an uneven price movement. To restore equilibrium, algorithms usually prompt price to return and close the gap, whether soon or in the future. This encapsulates the essence of the fair value gap concept. So, let's go to our charts and take a look at fair value gaps on a price action. So, if you take a look at this section of the chart, you can see we have 3 candles, and you can see the high of this candle is not linked to the low of this candle, and so it creates a fair value gap. Let me just put a rectangle right here to show you. So as you can see, the price goes up and then it comes back down to fill the fair value gap. These observations underline why some assert that price tends to revisit certain levels. When price diverges from this level, it's not inclined to just continue moving away. It usually returns to close the gap that was left behind. Take a look at the gap. Price surged from that point right after filling the gap. However, please note that this isn't a trading signal. I'm simply demonstrating how these scenarios manifest on the chart for your understanding. And here we have another section of the chart where we have 3 candles, and you can see that the high of this candle is not linked to the low of this candle, so we end up having a fair value gap. Let me put a rectangle right here. So, as you can see with this fair value gap, the market went up, and then it came down and filled this gap, and it went back up and it came back down and filled the gap again. These fair value gap patterns repeat consistently on charts. To master this concept, it's crucial to interact with your own chart and practice diligently. Remember to like this video and subscribe to our channel for more valuable insights. Click the link in the description to join our Telegram group and watch us trade. Happy trading!